Chapter 11, Accounting Periods and Methods. Accounting methods basically govern what year a taxpayer's income and expenses are recognized. These methods should be familiar to everyone from financial accounting as far as what the terminology is, but the rules that govern them are maybe slightly different. So generally when we talk about accounting methods, we're talking about accrual versus cash-based accounting, or sometimes a hybrid of the two in certain circumstances. We also want to talk a little bit about various types of tax years. Now generally a tax year is one full year, but we do have the 52-53 week year where you're basically picking to end your tax year on the same day of the same month every year. For instance, like the last Friday of December is when you end your tax year. And the obvious benefits behind that would be the ability to have the last day of your year coincide with like the last day of a pay period, so you're not having to worry about various accruals and other accounting and tax complications that may arise from other types. Now, obviously, the most common type of tax year is just going to be your general calendar year, January through December, but then also for various reasons, different types of entities may select a fiscal year that differs from the calendar year. Now, generally, selecting a tax year just coincides with whenever you file your first tax return. And your first tax return would be filed based on whatever tax year you select, and then that would then be, whatever date you chose as the end of your tax year would be the tax year that you chose. Now, C corporations have the option of choosing a fiscal year as long as it makes sense based on their business cycle. Generally, S corps, partnerships, and PSCs or personal service corporations have to use a calendar year. Once you pick your tax year, generally you're not able to change it unless you have IRS permission. And as you may expect, IRS permission is not generally all that forthcoming. However, it does come up sometimes. When it does, you would use Form 1128 to request that. And then if because of that, obviously if you change your tax year, there's going to be 1 year that is shortened because of that. So basically, or shortened or elongated. If there is a short period because of the changed tax year, in calculating the tax, you basically annualize out your income and compute tax based on that income. Then you kind of convert or de-annualize it back to whatever time period it is. And you also take just a pro rata share of any exemptions that are available to you. Generally, like I said, you need IRS permission to change your tax year. These are some exceptions to that. So if you're a newly married taxpayer and you change to be on whatever your spouse's tax year is, if you are currently, for instance, a calendar year taxpayer and you go to the last Friday of December on a 52-53 week year, then you would not have to get permission there. And then also, if all four of the criteria in number 3 there are met, you haven't changed in 10 years, there's no net operating loss as a result of the change, short year taxable income is greater than or equal to 90% of previous year taxable income, and there's no change in your entity's status, then you're able to change without permission. So basically, what that last one is talking about is basically trying to eliminate any incentive for you to change in order to lessen your tax burden for the year. Like I said, we have, when we talk about accounting methods, we're talking generally about a cash, accrual, or hybrid method. Generally, new taxpayers can pick any of the accounting methods. However, cash method is the only available method for entities that have gross receipts of less than $1 million. If there's a cost of goods sold. If there's no cost of goods sold, then gross receipts less than $10 million for all individuals and certain personal service businesses, and $5 million for corporations and partnerships that have a corporate partner. If a taxpayer has different lines of business or different business entities, then different accounting methods can be used for each of those. And regardless of the method, if you're a cash method taxpayer, you still have to capitalize and depreciate fixed assets. Also have to capitalize and amortize prepaid expenses. Let's see. Checks and credit cards are treated as cash payment for a cash method taxpayer. And notes are not. So a note payable would not be considered the same thing. So for note payable, you would wait until actual money changes hands. Under the accrual method, first are dealing with income. You recognize income when it's earned, and for instance, when goods and services have been provided. To determine if it's earned, you looked at the all events tests. So all events have occurred to fix the right to receive the income, and any amounts that should be or are considered earned can be determined with reasonable accuracy. Prepaid income is generally recognized when received, regardless of whether you're on the accrual method or not. However, you can defer recognition of prepayment of goods if your tax accounting method equals your financial accounting method. So in other words, if you don't have two different methods, so you're not cash on one, accrual on the other, or cash on one, hybrid on the other, or anything like that, as long as you're the same thing for financial accounting purposes and tax accounting purposes, then you can have that exception to the exception. For the deduction side, you can deduct only if both of these tests are met, the all events test and the economic performance test. So under, again, all events tests, all events have occurred to establish the fact that you have a liability, and the amount of the expense can be determined with reasonable accuracy. And then for the economic performance test, it occurs when property or services are actually provided by the taxpayer or the other party. So you actually have to have performed there. It's just kind of a little flow chart with some more specifics. For inventories, if you are a taxpayer that sells inventory, you generally have to account for that inventory using the accrual method. And if you use the accrual method just to account for inventory and then cash for everything else, that would be when you are selecting a hybrid method. Now, I'm not going to talk too much about UNICAP, so I'll skip that one. Those are just the various different methods of accounting for inventories. You should be familiar with those from financial accounting. We'll move into long-term contracts. So long-term contract is basically any multi-year construction or manufacturing contract that's building unique property. Doesn't include any contract for services or property normally carried in finished goods inventory. The various options you have in accounting for long-term contracts are percentage of completion. You have a modified percentage of completion, and then you have the completed contract method. Direct costs and allocated overhead are both subject to long-term contract rules, so they'll both be affected by whatever method that you choose to use. Long-term contract costs include direct and allocated overhead that are allocated to the contract. Anything not associated with the specific contract is going to be deducted currently. So these are some examples of those: selling, marketing, advertising expenses. And then interest expense has to be capitalized to real or long-lived property or any property requiring greater than 2 years to produce. Under the completed contract method, costs are capitalized and deducted from revenue only when the contract is completed, regardless of whether any cash advances have taken place. Under that method, you basically, as costs are accumulated, they build up in the work in progress account until the final contract is completed, and that's when they would be deductible. Under percentage of completion, you report income as the work progresses year to year. The formula for calculating that is you recognize revenue based on contract price times current year costs divided by expected total costs. So you're basically estimating what the total costs are going to be. You calculate what the current year costs are, that gives you your ratio, and then you multiply that ratio times the contract price, and that would be your recognized revenue. Whenever you have to estimate, and you're using an estimate rather than actual costs, you're subject to these look-back interest issues. And that's basically where the IRS wants to say, well, once all was said and done, we determined that the overall costs associated with this contract are different than what we expected those to be. So if that difference results in, or if that difference had been known when you paid taxes in earlier years of the contract, and that would have resulted in you having to pay more taxes in those years, then you actually have to go back and pay interest that should have occurred in those years, and then interest on that interest, so that the IRS feels like they're whole, and you haven't gotten away with, or you have no incentive to estimate that your contract price is going to be much higher than it, or that your contract costs are going to be much higher than they are, or in other words, that your revenue is going to be lower than it actually is. So there's no incentive for you to do that because you're going to have to pay the tax on that anyway. But a taxpayer is allowed a de minimis exception. This is basically when if you can make the argument that, hey, we weren't trying to get away with anything. It was a good faith estimate. It ended up being within 10% of the actual. So there's no reason we should have to go back and repay over a certain period of time. Under the installment sales method, this occurs basically when the sale is made and you're receiving payments on the sale extending past the current tax year. So under that method, you're going to compute the gross profit from the sale, determine the contract price, compute the gross profit percentage, compute the gain to be reported in the year of sale, and then compute gain to be reported in subsequent years. Obviously, the 6252 form is what you would use to report installment income, and that is assumed whenever the installment payment system is used, but it can be opted out of. Now skip over that one. These are a couple important bullet points here. Installment sale cannot be used for properties that are sold at a loss. And a taxpayer, like I said, can elect out of the installment method. So situations where you may want to elect out of the installment method would be when you would want to recognize a gain in the current year rather than spread it out over future years. So if you anticipate that you're going to have a loss this current year, a net operating loss, you may, and you expect not to have losses in the future years, it may be beneficial to you to recognize all of the income from this contract this current year and use your net operating loss to offset that income this year. That way, going forward, you don't end up having to recognize it. If property is sold in exchange for an installment note, there must be adequate interest charge or interest will be imputed to the seller. So basically, if you are selling on an installment note, we're going to assume that there should be an arm's length transaction, and that transaction will generally require some type of interest based on the time value of money. So obviously, the IRS just assumes there's not really any good Samaritans out there that are going to be willing to loan you this money effectively, extending out past a year, because, why would they when they could take that same money and go out and earn interest on it and gain money just from the interest? So they're basically saying either they're charging interest on the installment, or it's we're going to assume that the interest is implicit, and we're going to impute that interest, because we're going to assume that in a lot of situations it's one of these various scenarios where it's a gift loan, some type of shareholder loan, or compensation-related loan where we're trying to hide income by loaning money instead, or any other purpose where we're trying to avoid tax by making this installment loan. These are just some of the issues that come up in changing accounting methods. The biggest one there is obtaining IRS consent. Doesn't usually happen, but if it does, then you have to think about the amount of the change and report that amount as well.